Welcome to the Concierge CPA. I'm Jackie Meyer, founder of TaxPlanIQ software. This is a podcast for accounting firm owners and influencers who are pursuing world-class service. Let's go, y'all. Hey there, I'm Dr. Jackie Meyer, CPA, and welcome to the Concierge CPA podcast. Before we dive in, here's something exciting. TaxPlanIQ users are saving their clients an average of $40,000 in taxes per taxpayer while selling large tax plans. TaxPlanIQ is the ultimate resource for tax advisors. With nearly 500 firms on board, we're helping advisors build skills, grow confidence, and connect with a vibrant community. Want to learn more? Visit taxplaniq.com/podcast for exclusive discounts, resources, and other things mentioned in this episode. Now, let's jump in.
Hello. Welcome back, everyone. If you've been following this podcast, you've probably noticed things went quiet for a little while, and that was fully intentional. I hit pause to rethink everything, not because I was done, but because I wanted to make this show matter a lot more. So I didn't want to fill airspace and podcast space with fluff. I wanted to create conversations that give you actual aha moments where you can walk away thinking, how did I not know this before? So in this new version of the Concierge CPA, which we're kicking off today, it's all about truth over theory, strategy over noise, and ROI over ego. So we are talking about one of the most misunderstood tax strategies and most overlooked, but maybe one of the most powerful in the entire tax code, the Backdoor Roth IRA. And I'm joined by Acen Hansen. He's the managing director of Legacy Integrated. Welcome. And
thank you.
They are a wealth management firm that helps high-income earners keep, grow, protect, and preserve their wealth for generations to come. And as we were talking about right before we started recording, he wants his clients talking about him on the golf course, about the amazing alternative investment strategies that you're doing and oil and gas and stuff like that. So what's really nice, though, is that Acen and his firm, his wealth advisory firm, are also preferred vendors on this particular strategy inside TaxPlanIQ. So if you think you make too much for a Roth, or you think your clients make too much for a Roth, this episode is definitely your wake-up call. So Acen, welcome to the show. I can't think of a better way to relaunch this podcast than tackling a myth that drives us both nuts. So let's get right into it. Most high earners think they can't have a Roth IRA. Is that true or false?
Right. That's what we found. Yeah. It's kind of surprising how many people don't know about the ability to do a backdoor Roth. So yeah, most of the time they're like, oh, I don't qualify for a Roth, so I got to figure something else out.
Yeah, for sure. But that's completely false. There are ways to do it, right? And it's not a loophole. It's not a gray area of the code. It's all very black and white, right?
Yes, it is. Yeah. I mean, so much so. I mean, it's pretty easily available to be able to Google, but people don't really think about Googling or chat GPTing these days.
Right. Well, ChatGPT is my best friend. I don't know about you, but yeah. So the IRS does want everyone to save for retirement. They just kind of cap how much you can directly contribute once your income crosses a certain threshold. And that's where the backdoor Roth comes into play. It's an IRS allowed conversion. Is it IRC section 408A? Did I get that right?
To be honest, I don't know. I just know that I do it.
Okay, well, I'm going to roll with it because that's what I had written down in my notes. So you're contributing after-tax dollars to a traditional IRA, right? Which is our $7,000 annual limit, or $8,000 if they're over 50, right? And then you're immediately converting that balance to a Roth IRA. It's very simple, legal, and incredibly effective.
Correct.
Okay, so give us kind of what did I miss in just explaining exactly how that works? What's kind of like the step-by-step, play-by-play of what misconceptions people have with it?
Yeah, so there's a couple, and the first is, most of the time it's viewed as after-tax contributions to an IRA because usually people have maxed out their pre-tax contributions to an IRA. And then they're like, hey, I need to get some money to a Roth. So then they go after tax. That's not based on what we found. That's not entirely true. You can convert pre-tax money as well. So you would, contribute the pre-tax money into the IRA, and then you just convert the IRA money to a Roth IRA. It then essentially just adds that what you would have had for your deduction, adds that back into your AGI when you do the conversion. So that's something that we've found, and what we found with that is that it can offer some flexibility in the planning, because you don't necessarily have to, like today contribute to the IRA and then tomorrow do the conversion immediately. Like you can do it anytime within the tax year,
Okay.
do the conversion.
That's a great point.
So you can have a little bit of time to be able to say, hey, what if we, you know, uh, wait for this position to experience some losses, and then before we add that back into our AGI, and you can, capture a modicum of savings, in paying the taxes on that conversion. So, it's an extra step, versus just contributing directly to a Roth IRA. You have to do the IRA and then the conversion over. So it does add that extra step to get the money into the Roth IRA. But with that extra step, can provide some latitude to do some strategic maneuvering.
Yeah. Awesome. Okay. Yeah. I mean, here's the thing, deductions don't make you wealthy, right? I love tax planning and I love like immediate benefits, but what makes people wealthy is tax free growth. That's what we all need to aim
Hmm.
for. And that's what we can do through this strategy because we're getting the non deductible contribution, but then tax free growth and tax free distribution. And who knows what kind of landscape we're in 20 years from now when we retire, right?
Right. Right. Yeah. I mean, that's what we talk about with clients all the time. Is we all think the taxes are going to be higher when we're in our retirement years. So let's try to get as much money into the Roth IRA as we can, so we don't have to worry about the taxes at
Yeah,
that
for
time.
sure. Awesome. Okay. So the income levels, which I pulled because I do not have them memorized. So the Roth IRA contribution phase out starts at 150K for singles in 2025, I believe, and then 236K for married filing joint. And then they completely phase out. So that's where I guess it truly matters is the 165 single and 246K or so married filing joint,
Hmm.
that's when you cannot
Hmm.
directly contribute to the Roth. Is that right?
That's
Okay,
correct.
cool. Yeah.
Yeah.
Now, what's really cool is that in TaxPlanIQ, we have this whole wrap engine, read, analyze, propose, and we automatically will suggesting to your clients to do a backdoor Roth if that prior year 1040 that gets uploaded exceeds those AGI limits. And so we'll recommend it. We've got Acen and friends over here that are our preferred vendor to help you implement the strategy. What does that look like for our advisors and users that come to you for help?
Yeah, it's pretty basic. So for the client, we just open two accounts. We open a Roth IRA account, and we open a traditional IRA account or non-deductible IRA account. Um, and then they fund the one, and we convert. Once those funds are in, again, sometimes there's just some strategy in terms of timing, but before the end of the tax year, we convert it from the traditional or the non-deductible IRA to the Roth. Uh, it's on the client side, it's a couple signatures and an ACH in, or a wire transfer, however it is that they want to get the money into the IRA, and then it's a signature to initiate the conversion from the IRA to the Roth IRA.
Mm-hmm.
Client side, um, CPA or tax advisor, uh, hardly any work involved. They would get the reporting from Schwab that would show the conversion, and they just um, I've never completed taxes, so I don't know necessarily the line that they look at, but they there's a pretty easy line to show conversion amount, that they would then put into the tax return.
Yeah. Okay.
Easy.
Awesome. And so not only can we do this 7,000 or 8K a year, but what we recommend in Tax One IQ to show the more longer term wealth and growth is to set like a annual market rate to show that tax free growth, right? And so, what would you
Mhm.
recommend in our current climate in 2025? What's a good, like, average or not so aggressive market rate that you could say, hey, this Roth's going to grow at 6% or 8% or whatever that is?
Yeah, with that, it's always the situation as the boss. It's like, what is the client's risk tolerance? What how what amount is in the Roth IRA that gives us the latitude to be able to invest in certain strategies or whatever. We do typically try to encourage our clients to be a bit more aggressive with their Roth IRA accounts, because it is going to be something that they're not going to be accessing for a bit. They're going to be continuing to contribute to, so they can handle potentially a little bit of volatility to hopefully capture some higher growth capability within that. And then when they get closer to the age where they're ready to actually start withdrawing money from the Roth, we can dial back um, the aggression, I guess, for lack of a better
Okay.
term, to be more so. Our experience, again, this is painted with very broad strokes, is 10%, give or take a few percentage either way, that we have with clients in the Roth IRA. Um, we also believe that not all rate of return is created equally. And so, if we have a 10% that has, a lot less volatility than another account that has a 12%, average rate of return, we might actually end up ahead, because we're experiencing growth in years on a higher number because we don't have as much volatility, in a down year, for instance. So, um, like I said, that's painted with broad strokes. 10%, give or take a percentage, either way, is what we've experienced for a handful of clients. We have some clients who are high teens, 20s in terms of their return experience, but they're also very, very aggressive.
Yeah.
So,
Awesome.
you know, they're-
Now, are you,
uh,
forgive me for my lack of knowledge here, but like when you're investing the funds in the Roth, are you actually doing alternative investing in the Roth or do you steer clear of that?
yeah. Again, situation of the boss, but we certainly have a lot of clients with Roth money that has a lot of exposure to alternative, illiquid, off market and investments.
Cool. Okay. Awesome. All right. So let's talk a little bit not only about the backdoor Roth, which we mentioned, but there's also something called a mega backdoor Roth. How would you concisely explain what the heck that is and why it works even better than just a regular backdoor Roth?
Yeah. Uh, the Mega Backdoor Roth is, I think, for me, the most exciting thing, especially for high income earners. So, it uses that one does use after tax contributions to a 401k, or a 401k if they're an employee, or I guess a solo K or something if they're an employer. But with the Mega Backdoor Roth, you can contribute up to about 70,000. It's like 69,000 if you're below 50, and it's about like 76.5 if you're 50 plus. Um, and then if you're a married couple running a business, the spouse can also do that. So you could get up to 100 and what is that 150,000 into a Roth vehicle every year
Wow.
if you have, and that's between the employee contributions being maxed out about 23,000, the employer doing 6 with a match, and then a safe harbor contribution of like $40,000 additionally. So there's a lot of money that can be jam packed into an IRA, and that gives us a lot of flexibility with regards to timing. There are funds that are set up specifically for uh, Roth conversions. So just kind of, high level illustration, if somebody puts in $100,000 into their IRA, a lot of that being pre-tax, some of that being after tax, they put in $100,000 into their IRA, and then they get into a fund that is some sort of real estate fund or drilling fund or a structured note, something that has a built-in discount on the
Uh-huh.
pricing. And they get in 1,000, you get a $20,000 discount because of the reappraisal, um, and then you can convert the money at that point. It only adds in 80 instead of adding in 100, so you could capture some arbitrage on the pricing that can help with, again, like you said, you don't get rich off deductions, but there's a scripture that I love that says, "By small and simple means are great things brought to pass." You stack all these small efficiencies that can make a big difference in the outcome for the clients later.
For sure.
Yeah, so there are funds that can be used in tandem with the Mega Backdoor Roth of being able to get $150,000 into a Roth vehicle every year. And it's just another step um, versus contributing to the Roth directly.
Okay, yeah.
Hey, it's Dr. Jackie. Are you enjoying today's episode? If you are, here's how you can support the podcast. Like, share, and subscribe to the Concierge CPA podcast to help us reach even more listeners. Continue the discussion and connect with other accounting professionals in the Accounting Firm Influencers Facebook group or follow me on LinkedIn. Thanks for listening, and now let's get back to the show.
So if you're an employee, it's essentially just an employer check the box choice of enabling that option, like the Roth 401k contributions.
Yeah, and every plan is different. So not all employers offer a Roth capability. Not all employers offer a self-directed capability. So obviously it depends on the plan docs with the 401k that come from the employer. But if the Roth is included, if the Roth IRA component is included, and if the client has the ability to do self-directing, they can do a Mega Backdoor Roth. Um, Again, if the employer also contributes, and often we have found, like, not all employers necessarily offer safe harbor to everybody where they're maxing out all their contributions to their
Mm-hmm.
employees. But there are some plans that, if you go to your employer and you're like, hey, can you, instead of paying me my bonus, can you, do it as a
Right.
um 401k match or safe harbor contribution or something along those lines. Often employers will uh happily help, we have found.
Nice. Okay. And is it like a or situation, like you can do your max employee contribution to the solo 401k, or you can put it towards the Roth, or is it like a some kind of combination of both?
It's essentially a combination of both. What you're essentially doing is you're maxing out your contributions into your 401k, and then you're converting those contributions to a Roth IRA. That's essentially kind of the, as simple as it gets. That's essentially what's going on.
Okay, cool. All right. So
Yeah.
your firm's name, Legacy Integrated, it says a lot about, I think, the philosophy you hold. So how do you really help clients think beyond investments and really think more about their legacies?
Yeah, that's a great question. Nearly every one of our conversations we have with clients, a lot of people come to us and they're like, hey, I earn this much, I've got this much in my 401k, I've got this much in rental properties or whatever it is. They kind of tell us the numbers of what's going on in their world. But we like to kind of talk to them and be like, okay, like, what are you doing all this for? Who is this benefiting? Oh, I want to make sure that my kids or my grandkids or my great grandkids are, taken care of. Or, man, I just would really like to be able to not have to work anymore so that I can spend time working with the ALS Foundation here locally. Whatever it is that they're doing. And we really want to strive to understand what the clients are working toward, so that we can help them figure out the best way to accomplish their overall goals. Because if they come and just talk in numbers, we can say, yeah, you could save money doing this, you could save money doing that, or you can get into this investment which could have a potential upside of this. And it's fine to be able to do that, but if we understand, okay, I want to accomplish these things and here is why, then we might be like, you know what, we hadn't even thought of this, but if you're looking to do this, there's this whole other strategy that's totally unrelated to what we were originally thinking that might actually be better suited to help you get to where you're going. I often use the analogy, um we're just helping our clients navigate their our logo is a ship. And so we're helping our clients navigate their ship to their destination. And you know, uh, we have the map set out. We know where we want to go, and we're kind of moving that way. But if you got headwinds or a tide or
Mm-hmm.
some sort of current that potentially throws things off course, we can adjust and make sure that we're getting back to where we want to go, um, and making little adjustments every year on the along the way. Um, but as long as we kind of know what the North Star is, we can constantly help our clients work toward that. And, maybe, hey, we found a shortcut. We can take the Panama Canal to save ourselves,
Right.
so there, there's all sorts of different conversations about why we're doing what we're doing that helps us determine how we're going to get to where we want to go with the client.
Yeah, awesome. That's beautiful. And I really couldn't agree more. I think thinking about legacy and wealth, if there's no purpose involved, it's really just a lot of anxiety with zeros added. And at some point, it does become a lot more than just how much you make, it's how much peace that you get to keep. And when your wealth plan aligns with your purpose, that's when you can experience what I call a return on you or a return on investment in yourself to the world. So that's really neat that you're able to support your clients through that journey. And I love the boat analogy. That's really neat.
Yeah.
All right. So, few more minutes on the backdoor Roth or mega backdoor Roth. Any other big misconceptions that you want to dispel or aha moments that you might want to share in regards to those things that we haven't discussed yet?
Yeah. It's more essentially just a reiteration, like a lot of people just kind of immediately hear, hey, I earn, we as a couple earn a $250,000 a year. We don't make, or we make too much to be able to get into the Roth. And they kind of stop. It's like, man, there's so much opportunity with having this extra step that, can yield potentially meaningful tax savings. And I'll just kind of share one story. So we had an alternative investment that we were using. They did mineral rights consolidation. So they would buy the mineral rights for essentially oil rich areas in primarily Texas is where it was where this fund was operating. Anyway, so um, then they would sell the consolidated mineral rights to big developers so they could go out and drill. So during 2020, there was kind of that weird period of time where the price of oil went negative. I don't know if you
I
remember that.
do.
Um, and I don't know if it had necessarily to do directly with the pricing of oil, or if it was just like a reporting issue that we had with TD Ameritrade, who was our custodian at the time. But we had a bunch of clients who had some money in this fund, and they had it in their IRA. And there was a period of time, about a week, where the pricing was $0. There was nothing wrong with the rights that they had. We knew that um, the mineral rights were in a very prosperous oil
Hmm.
area that was still ready to be developed. And so then we just converted the ownership from that uh, from a IRA to a Roth IRA, and we can convert it at $0. So there was zero AGI added back into the client accounts,
Wow.
and they got $4 million in that position. Um,
Awesome.
so they we were able to move $250,000 without any taxable capability. And if we directly contributed to the Roth, directly, that wouldn't have been able to have that opportunity pop up. And we do things like that. That was obviously the biggest one. Man, we felt like we were geniuses. We were patting ourselves on the back because we were for our clients. But um, that extra step of going to the IRA first and then converting from the IRA to the Roth IRA offers some meaningful opportunity to be able to capture some tax efficiencies. And I always tell my clients, like, you know, we want to help you and your CPA pay as little money in taxes as you legally can, because our clients are going to do better things with that money than Uncle Sam will. And we believe that, and a lot of our clients are employers themselves. So it's like, man, you got more money that you can hire more people to deliver better product, or pay your people better so that they can uh, uh, have kind of peace of mind for themselves as employees and all that type of stuff. And it's just anyway. So I really believe in being able to have some flexibility with that extra step that is taken with the IRA, with the backdoor Roth and or the mega backdoor Roth, can offer some meaningful uh, tax planning and being able to do that, in that particular year. And like I said, that one where we were able to convert a position that was priced at zero, there was nothing wrong with the position. We just retitled that position from the IRA to the Roth IRA, and then all of a sudden, when it gets repriced, and that reporting issue or whatever is adjusted, all of a sudden they've got 100,000, 250,000 in their Roth IRA that will never be taxed again.
Yeah, that's
Um,
amazing.
They did it for a dollar basis. So
Very cool. That's an awesome example. Thank you for sharing that. Okay, cool. Well, let's see. I think I'm going to go into our little lightning round to wrap up, where I ask you some really quick questions. They're just kind of for fun, to get to know you a little bit better. Does that sound good?
sure.
Okay.
I love it.
So, what is one financial myth you wish would die?
Man, I've actually got a bunch of them. But I'll say that we run into a lot of clients who have rental properties, and like they're just like, man, I'm getting $500 a month of cash flow on this. And then like when we take a step back, we're like, man, your return on equity on that, like you're getting 2%. Like the national average
Yeah.
of rent is they're getting about 2% income. And a lot of those people, I mean, they're working really hard for that 2%.
Mhm.
Uh, so, like I'm a big fan of real estate. We use a lot of real estate for our clients, but I just think there's a lot of people who in their minds think that they're doing better in their as a real estate owner than they actually are, and they're working too hard for the money that they're actually making.
Yeah. Oh, that's such a good one. Okay. All right. Humor me. Give me one more since you said you had so many.
Um, there's a lot of folks who are believers in the infinite banking strategy with life insurance.
Mm.
I'm a big fan of life. We have a lot of clients who utilize life insurance. We place a pretty decent amount of life insurance every year. But a lot of people are taught that, man, life insurance is just the end all be all, and you can have your dollar working for you 3x what it actually is. And there is some capability being able to utilize the arbitrage in borrowing from a cash value and investing in other things, but um, there's a it's not as bulletproof, foolproof, ironclad as people think. And we've seen a lot of those plans blow up,
Mm.
and partially because it get misdesigned, partially because the clients think, hey, I've got $100,000 in there, I'm going to pull it all out and go get into this thing, and then suddenly there's no cash value in there to help make sure that the cost of insurance is taken care of and the policy lapses. So again, big fan of life insurance. I just think that it's often misrepresented and oversold, and it ends up being something that does not fare well for the client, because it's not appropriately understood.
Yeah, not managed well as what you're getting at too, because you do have to
Totally.
follow the rules. Yeah, we have the LIRP, Life Insurance Retirement Plan Strategy, is in TaxPlanIQ, and we have a specific provider, Dave Spence, that he eats, breathes, everything LIRPs, and he loves them so much. But like, he's seen some real bad apple.
Yeah, they're
Yeah, for sure. Okay, cool. What is another tax strategy that you really love?
qualified opportunity zones. Huge fan of them. Anybody who has a meaningful capital gain. This is actually a really interesting time right now because the first QOZ is about to sunset
Yeah.
in 2026. And then any capital gains in like the first half of 2026 aren't going to be eligible for cap gain deferral. So this is an interesting time, but I love the qualified opportunity zones. I think a fantastic alternative to like a 1031 exchange or a 721 exchange, because the client can kick the capital gains down the road. I think it's 2031 now, is or no 2035. Anyway, kick the capital gains tax down the road 7-8 years. That buys a lot of time for strategic planning. Oftentimes, QOS, qualified opportunity funds, have a liquidity event planned in
Mhm.
for what's tax year. But you get your gains put into this thing. You can keep all the basis for yourself, so you don't have to worry about 1031 ratios that are subject to anyway. So I love that. And then if you hold the fund, which most funds are planning on holding at least 10 years, any capital gains you realize from the time you made that exchange to the time that that gets liquidated is not going to be taxed at all. I just love that. So, buys 8 years worth of deferrals on the capital gains. Oftentimes the funds have some sort of liquidation event to be able to pay that tax at that
Mhm.
time. And then if you hold it for the full 10 years, you don't have any taxes on that gains at all. It's able to kind of take it out of the 1031, kick the can down the road kind of, hamster wheel. And clients can then actually like have that money and then do something with it. So I love that. I think the qualified opportunity zone is awesome. Plus the economic benefit that it yields on the other side.
Mhm.
The whole idea is to invest in economically depressed areas and help
Right.
revitalize or rejuvenate them. So I think it's a great scenario on both sides for the investor, for the investment and what it's benefiting. I think it's a huge strategy. And then I think timing wise right now is pretty interesting. If you advise tax advisor have any clients who are thinking about selling a business or selling a rental property or having some sort of big capital gain, and they own that asset in an LLC or other pass-through entity, have them wait until January 2026 at least, because the K-1 doesn't get issued for that entity until March 2027, and that's the timer for which the capital gains um, 180-day window
Yeah.
starts. So then get into a qualified opportunity zone and defer those
I
gains,
love
and
that. That's
can maybe
exactly what I was gonna
you can
ask you. It's messy. I loved that they didn't necessarily extend QOZs in the new OBBBA bill. I'm still
I,
wrapping my head around that name. But they're reframing it in a way that makes
yeah,
more common sense. So I you have to be very careful about the timing of exactly when you invest and that kind of thing. And so that's where someone like Acen can really help you out. So I appreciate you bringing that up.
yeah, thank you. Yeah.
Okay. What is a book or quote or speaker maybe that has really kind of changed your life or the way that you think about things?
I've got one for all three of those. The quote is it's Abraham Lincoln when he was campaigning during kind of the Civil War. He was in the North campaigning, and somebody asked him like what he thought of the Southerners, and he was like, "Oh, I think they're good people, who are misunderstood or something like that." And one of the people in the crowd like kind of chastised him, like, "Hey, they're your enemies. You should wish them dead." And he's like, "You should wish to eliminate your enemies." And he said, Do I not eliminate my enemy when I make him my friend?"
Mm,
Um, love that quote. It really has helped me reframe. Like, I try to really always come at a new relationship from a collaborative standpoint, even if there's somebody who might be viewed as a competitor.
hmm
Because I think there's iron sharpens iron. I think there's a lot that can be gained from doing that. Um, uh, a speaker who's changed my life. I'm a big Darren Hardy acolyte. I think I love everything that he does with the Success magazine that he had before, and now he just kind of does business master classes and things
hmm
like that. That information, I love him. I think he's fantastic. And uh, the E Myth, I read the E Myth pretty frequently. I think that's a great book on just really understanding the difference between working on your business and in your business.
Yes,
And
yes. Oh my gosh,
I've
it's on my shelf back here somewhere or other. But yeah, I'm constantly referencing back to it because we so easily get stuck in that technical worker mode instead of the entrepreneurial spirit, especially as service industry providers, right?
Yeah,
Yeah. Oh man, those were great. Okay. And I love that you brought up collaboration because honestly, it's the future of our profession. The best advisors collaborate and the average ones are out there competing. And so it's really how you can quarterback an entire situation and make friends with everybody versus enemies that it's going to be the best opportunity there is. So that's definitely how clients win. And I think that's how us as advisors win too.
agreed. Could said it better.
Awesome. Okay. So, what is the best way to contact you if people want to learn more?
Yeah, I would encourage everybody. I mean, we have our website. It's thelegacyintegrated.com. You can come visit our website. It's being updated right now. So, if you come at the right time, like I think I told you, Jackie, I don't know if the audience knows, we used to be clients of TaxPlanIQ because we had a tax arm
Yeah.
in our business that we have since relinquished because we wanted to focus on just what we do well. We realized that trying to also run a tax business wasn't necessarily serving our clients or our team. Um, so if you come to our website as a tax advisor and you see we do taxes, we're no longer doing that, but we do, believe in tax smart investing. So you can come to our website. There's some contact, information there. You can go there. The best way is to email our concierge team. It's concierge at thelegacyintegrated.com. We've got a team of about 5 gals who are all just as organized and buttoned up and dialed in as possible. You can email them, kind of say, hey, I heard about you guys, wanted to learn more, and they'll get you, with me or with one of our advisors to talk about a client situation, whatever, to be able to, chat about whatever you, the advisor, wanted to chat about.
Yeah, no, that's great. Concierge team. I like the sound of that. All right, Acen, thank you so much for your time today. This was really a joy for me to hear about how more people can access those basics, but then also expand upon them as they go to higher net wealth. So thanks so much for your time. For our listeners, I hope that you enjoyed this. Please shoot me a note anytime if you have any feedback or suggestions. And I wish everyone a very blessed rest of your day. So thanks, everyone. Take care. Bye.
I appreciate you listening all the way to the end. It truly means a lot. As a thank you, I'd love to give you a free gift, my value pricing calculator and proposal workbook. This tool has helped tax advisors create 8-figure tax plans and save over $1 billion for their clients. You can now download it at TaxPlanIQ.com/ROI-method. Thank you for being part of this journey, and I'll see you next time on the Concierge CPA podcast. Take care, y'all. Thank you for listening to the Concierge CPA, hosted by TaxPlanIQ. We believe that every person has a unique message that can positively impact the world. If you are a successful accounting firm owner or influencer who would like to be on this program, please visit JackieMeyerCPA.com, JackieMeyerCPA.com to apply. Please share this on social media and rate us so we can continue our good work. Join our Facebook group called Accounting Firm Influencers, or connect with me on most platforms under Jackie Meyer CPA. Thanks for being accountable to transforming our industry today.